The Bank of England left interest rates unchanged at 5.25% today, which is in line with expectations. The vote compared to last month was a little bit wider. If you remember at the last meeting, the Bank of England voted to also leave interest rates unchanged, which was against market expectations, and it was a very close vote, 5-4. Today it was 6-3, so clearly a slightly increased view at the Bank of England that interest rates may not need to rise further. Perhaps that's driven by their more downbeat forecasts for both growth and inflation. They expect inflation to fall to 4.8% in October, which should be confirmed in the next couple of weeks, whether that is the case or not. That's from around 6.7% the month before, which is a very sharp decline, as Governor Andrew Bailey alluded to in a speech last week, but it is driven by comparables. So obviously October this time compared to October a year ago. Last year we had an increase in the energy price tariff. This year we've had a decline in the energy price tariff. Things like fuel prices, etc., food prices all feed into that. So that was a very sharp decline in their forecast for inflation in October, but it carries through over the next few years as well, to the extent that in 2 years, their kind of modal forecast for inflation is around 2%, and over the end of the forecast period is below 2%. So there's two things we can take away from this. One is that the Bank of England therefore may be looking to cut interest rates at some point during that period in order to get inflation to 2% rather than below 2%, which isn't its mandate. But the other thing we can take away from this is that, considering the revisions we've seen just this time alone, but we see this every single quarter, these are very uncertain times. So those forecasts are going to be subject to heavy change between now and that point in the future. But perhaps it helps to explain why one additional policymaker voted to leave interest rates unchanged at this particular meeting. And that uncertainty is something that the governor of the Bank of England and his colleagues alluded to in the press conference after. And I don't think they're under any illusion that this is going to be straightforward, that their forecasts are going to be entirely accurate. They alluded to the fact that the labour market is showing a little extra slack, but they did increase their view of where unemployment should go to before we start to see significant signs effectively of over tightness or over looseness in the labour market. So it was previously 4.25%. Now they believe it's closer to 4.5%. The reason why that's important is because it's driven by their view that the reason why wages are still rising rapidly, even though unemployment has surpassed that 4.25%, is because the labour market is still theoretically tight, and therefore wage growth may not dissipate even with unemployment at 4.3%. This is all effectively technical jargon, but it helps to explain the Bank of England's decision making and forecasting that we've seen today, and also going forward. But it does also highlight another thing as well. Wage growth is going to be key. Of all the economic indicators we're watching now going forward, I think wage growth is going to be the most important one. The other reason why I think that's going to be the case is because the other thing they highlighted was services inflation. Now they've said core goods inflation has come down, food price inflation, energy price inflation, although there is subject to upside risk because of what we're seeing currently in the Middle East and the impact that's had on oil prices. But the one area of concern for the Bank of England is services price inflation. And what is a big driver of services price inflation? Well, that takes us back to wages once more. So wages are still far too high. I do think they are going to come down over the course of the next 6 to 12 months. And I think the Bank of England is in agreement with that. But because they have stayed so sustainably high for such a long period of time, I think that's where the significant upside risk to their inflation forecasts come from. If we can see more progress on wages over the next 6 months, then I think we'll see significant revisions to both the inflation and the growth forecasts from the Bank of England. Say by the time we see the next couple of forecasts in February and then in May of next year. But again, there's a lot of ifs and buts within there, but that uncertainty certainly came through from the Bank of England, as well as other central banks that we've heard from for a long period of time now. So that's enough of the fundamentals. Let's take a look at the technicals. And here we have a pound-dollar chart. Now, a few things to note first. One is the trend that we saw over the course of the summer, and you can see that was downward. The reason for this is because expectations for the Bank of England base rate has fallen a lot in that time. At times, the view was that the peak would come around 5.75, even 6, maybe even 6.25%. And that's now fallen back to 5.25% where it currently lies. So that kind of dovish move has weighed on the pound at a time when the economy is struggling. And that's happened at a time when the US economy has been really resilient. So while people don't expect the US interest rates to rise from here, there is a view that it'll be very difficult for the Fed to start cutting rates anytime soon because of the resilience that we're seeing in the economy. So that's benefited the dollar at a time when the pound has been struggling. So that explains the move that we've seen down here. Now, for the last month, we've actually seen consolidation in the currency pair. And what's interesting about this is because we've seen this higher lows and these lower highs, it created a bit of a pennant formation. It doesn't really give you that much of an idea as to where the breakout will come, especially after such a long period of consolidation. We've got around 25 candles in this period, so it's very difficult to gauge the directional bias, I would say, at this stage. Maybe it's still slightly to the downside because of that preceding trend. I just don't think it's particularly strong at this point. So I think the breakout itself will be the clearest indication, of course, as to whether we're going to see a continuation of that move lower or whether we could potentially see a breakout to the downside and a deeper corrective move. Ultimately, it's all going to come down to the economic data and what that ultimately means for interest rates. As I highlighted in the video, the key one for the UK now for me, aside from the obvious inflation number, is wage growth. But for the US, there's a more wider range of important economic indicators. There's been a lot of focus on the labor market beyond wage growth, the idea being that the labor market's still extremely tight and it's very difficult to get rid of wage growth and inflation without that. So the jobs report tomorrow is going to be incredibly key for the US. But also there's other indicators as well from the US that lead into those figures, especially things like the surveys, jobless claims, plenty of economic indicators that the Fed's going to be paying attention to, looking for signs of weakness in the economy that could allow at least the conversation to begin about whether interest rate cuts are on the agenda. And I do think that those signs will come in the coming months, but at this point in time, it's not something that the Fed can even consider. So there's a lot of economic data to come. The next big one, as I say, the US jobs report tomorrow, at which point we could start to see some movement in this pair. But at this point in time, a stream of lower highs and higher lows means we are in consolidation.